baby, tech stocks are getting eviscerated to kick off the first trading day of 2024, and you damn near can't tell me that it has to do with tax loss harvesting. Heck no. So we're going to review 3 tech companies that I think have some of the most vital impact on the economy, where we kind of sit at the end of 2023, what the last earnings kind of showed us, and where we're likely to be moving forward, and where I think the best gains could potentially be. But if this is a conversation you'd appreciate as we view the broader market, let me know what you think in that comment section below. And damn it, while you're down there, just hit that like button. Always helps the channel out. But let's take a look here, because the heat map shows us some interesting stuff today, with first and foremost some of the most hit sectors of last year were in the healthcare space. We're talking about things like Pfizer. Pfizer is up 3.5 points just to kick the year off after being one of the worst devastated mega cap companies of last year. In the bottom of the bottom half of the market, as I mentioned last year, I think is going to resonate into this year, that it might outperform the upper half, because again, the interest rate environment mainly affected the lower half of the S&P. And the lower half of the S&P has been trading between a 16, I think it's around a 16 times multiple right now, which isn't that high compared to these crazy tech companies that are trading at 30 times multiples. But you take a look today, and Apple just getting eviscerated. Yeah, man, we got a 4% move in Apple in one day is something to take pause for, my friends. You got Nvidia down 3 points here. You've got Amazon down 1.6%. I'm not really as fixated on Google or Meta. These are more advertising plays. I always just like looking at these big branded companies when, they're moving at this kind of extent in a single day. And a lot of people are saying it's because of downgrades. Like Apple trading down 4% isn't just because of a downgrade. Barclays came out and lowered them from 161 to 160. I don't think a $1 change in a price prediction is going to move the entire market, especially that amount of shares in Apple. And I think when you take a look at Apple, I think this is the era of Apple's fall. I mean, and I'm not saying that in a bad way. I'm a long-term bull on Apple. I'm just saying in the macro, Apple has never been so inflicted by short-term pain, and they are feeling it pretty immensely compared to the other mega cap companies. They have some of the highest debt load on their balance sheet compared to their prior history. Every segment is pretty much losing capital for them, unlike it has been in the past. I mean, you look at the services business, it's the only business that is really growing for them, probably thanks to a lot of subscription-based services. But when you look at some of the growth in cloud and some of these other aspects of Microsoft and AWS with the likes of Amazon, and this is the only business Apple really has, but it is highly, unimpactful and comparable to the drops they're seeing in a lot of these other industries for them on the year-over-year basis. So they're not really growing like they once were, and this is leading to some concern when the company's trading at a 30 times multiple. You look at the revenue has been completely just flatlining and slowly trending to the downside. So we'll see what Christmas can do for them, as they were highly marketing the iWatch. They've been very uninnovative basically for the last at least 6 years. They haven't really done much outside of AirPods. I mean, that was the last big innovation. We talked about the Oculus and the VR stuff, and I just don't think that's going to be as pivotal to move the needle as Apple might want it to be at their current price point, which is honestly disgusting, in my opinion, for kind of breaking into the retail market in comparison to the competitors that exist out there. So their earnings haven't really been growing all that much. You take a look at their gross margins. They have pretty good gross margins. I mean, trading anywhere from 25% to operating at around 30%. Their gross margins are still very healthy, and this really just comes into play too with a lot of the repurchasing of shares, which is starting to basically peter off. They are not purchasing back the same insane amount of shares that they had been once before in the past, right? So that's also going to start inflicting some of that EPS growth that we've been experiencing here as well, right? We can kind of see this in the dwindling purchases, but I'm sure Apple will shine a light on how many share purchases they're going to be doing this year. But one stock that I think is going to rival Apple, and it has to at some point in the future, is Amazon. Amazon is a behemoth, I think, beyond most people's understanding. And I'm just shocked that it isn't sitting at an all-time high where Apple is. I mean, this company's down still 19% from its all-time high. It's not a stock that I've ever really wanted to buy, but you've got to recognize the growth in e-commerce hasn't reached parity with the market yet. It has been hitting record revenue numbers pretty much this entire year. It's still been growing at, it's starting to get back into a double-digit pace here. It looks like the last quarter was about a 12% growth rate, which is likely to do even exceptionally well into the holiday season, because let's be real, everybody was basically shopping online. There's a lot of stories coming out about brick and mortar getting hit over the holiday season. I mean, you take a look here at their shares outstanding, and unlike Apple, because they've been growing so aggressively, they've been issuing a lot more shares, and this is a bit of a concern. I couldn't imagine if they started just getting profitability and saying, hey, with that profitability, we're just going to start buying shares back, what that could possibly do for their entire growth of their stock. But you have to recognize when you're liquidating and putting more shares on the market, not a crazy amount of shares. I mean, you're only going from 10 billion in 2018 to what is it, like 10.5 billion. We're not talking about huge share dilution, but it is starting to pick up a little bit more into the last couple years, and especially the last last few quarters, to say the least. You take a look at the gross margins. They don't have a lot of margins here. This is a company that at least their gross margin is sitting around 46%. Apparently, I did not know that. But their operating margins, because they spend so much damn capital on reinvesting, has been abysmal. And I hate how everybody compares so many companies, growth companies, to Amazon. They're like, well, if Amazon did it, they never showed profitability pretty much for their entire publicly traded history. And look at the size of it. That's not going to be every company, folks. This is like Amazon is a true outlier for how it's been able to grow, not really bringing in any positive EPS pretty much for its entire history, right? But Amazon is one to watch as the e-commerce just never ceases to stop. It is like an unstoppable force as the entire world transitions to online. But we also got Nvidia here, right? And Nvidia is one to watch because this is a train unlike any train that has ever existed in the S&P top 10. And I say that I'm hoping I'm saying that with more passion than I'm letting off, because I've never seen a company like this in my life. Not only is a mega cap company trading like a penny stock up 233% in the last year, it's one of these companies where it will be the largest company in the world if it is able to sustain the growth path that it is currently on within a year. And you just take a look at this here. I mean, we're talking about a company that was on its verge of being a bubble collapsing to pretty much seeing its revenues jump up 50 to 100% just within a few quarters. It doesn't matter how you look at it. The EPS is absolutely jaw-dropping, bonkers, ludicrous, insane. You take a look at their margins here, bonkers. I mean, this doesn't even represent the recent gross margin that was sitting at like 70-something%. I mean, they're saying the gross margin is 69. You will not find a tech company on the S&P top 10 that has anywhere near close to these margins. And I'm saying this because, again, last quarter, I think it was 74% gross margin, which means every $100 they sell, they keep $74. And this is one of those trains where you know it's going to be unsustainable long term. I mean, you run the math on it, and if Nvidia kept this up even for 5 years, they would probably tenfold the like of Apple. I mean, it's coming quick. That's why people, I don't think, understand the gravitas. They're going to have a toss, I'm going to say, of a company like this. And this is also a company that has been purchasing back shares as well as of recent. I mean, we've been seeing their share count go down. They've been doing everything right for shareholders in this recent AI boom. I mean, we're starting to see crypto come back. That's going to bode well for them on the crypto mining side. Talking about gaming, the nuance of gaming and AI. Like, they're basically seeing like such a growth vector in cloud, and they're able to capitalize on so much. But again, that doesn't mean some competitors aren't going to come for their lunch. That doesn't mean it's going to be sustainable. We don't know. It's an industry that you could see being futuristic on levels unimaginable, but how long is that tap of oil? How big is that oil well where we just tapped, right? How long is that oil going to be able to get sucked up for and benefit shareholders? But to be honest, I'm not one of those people that's going to say Nvidia's in a bubble. I'm going to say this is largely unsustainable. But I mean, if you buy it right now and it gets another year out of what it's already done, you probably bought it at a pretty good value. I mean, like, you can't argue that, right? And then finally, the stock that I'd love to buy that I just can't buy yet, and I beat my head against the wall with this all the time, and that has got to be Tesla. Tesla just posted some pretty good delivery numbers, coming in at expectations, just above expectations, delivering, 1.8 million vehicles for 2023. Again, the big problem with the deliveries here, though the numbers are great, I just don't expect this to lead to any major impactful revenue growth. It'll be neat to see what the other parts of their business are doing when it comes to obviously charging, when it comes to solar roofs and the power walls and their battery storage, because I think that's where the real growth potential is going to be in the near term until interest rate cuts start to come into play and the car market starts to recover here, because they've just been eating into their gross margins, cutting prices way too much the entire year. And we'll see if they offered any further incentives over the holidays to get rid of some of their backup inventory and build up these delivery numbers. But it's going to be really neat to see what Tesla is going to be posting for the year. But I think the latter half of the year is going to be better than perhaps the first quarter or two. But these are just my healthy predictions coming into the new year, and I'd love to know what you think about these tech stocks getting absolutely wrecked, because I don't think anybody was anticipating that day one. But let me know what you think in that comment section below.